Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank using the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarah Ibrahim. For today's special guest, I have with us a special guest who's also a fellow infinite banking professional. So it's nice to have on fellow infinite banking professionals because it's like having somebody that speaks the same language as you. It's pretty cool. He's gonna share some insights on infinite banking and how he's using it for himself and for his clients. His name is Drew White. He's a former pediatric oncology nurse turned modern wealth consultant for real estate investors, business owners, and athletes. He teaches people how to become their own bankers and strongly believes that everyone should fire their banker and control their own money supply. Drew wants to bring back banking to the you and me level. He graduated nursing school with over $150,000 in student debt, and that led him to a path of entrepreneurship, real estate investing, Bitcoin, and infinite banking. Drew, welcome to the show.
Thanks for having me, Sari. How are
Yeah,
you
thank
today?
you. Thank you. Thanks for joining us. I'm excited. I'm excited to talk about infinite banking, how you're using it. Before we jump in there, can you tell us a little bit about your background and how you found out about infinite banking, how and how you became a professional in that space?
Yeah, yeah. Well, like you mentioned in the intro, I had graduated with $150,000 in student loan debt, which led me pretty much down a path of like financial discovery, which is a very slow, probably 10-year progression. And I used to be a Dave Ramsey disciple, which I don't want to bash him on your show, but
Go ahead. Sorry.
he did. I will say he did help me start down a path of just trying to start to ask some questions about money and so I took a long and winding road and started looking and realizing that my mindset was wrong around money.
Mhm.
So started shifting that, started looking at real estate, business ownership, and then just randomly last year, early in 2020, I took my kids to a playground and just listened to this podcast where these two guys came on and they said, become your own banker. And I was just like, what the heck is that? I've never heard that. And so of course I did a huge deep dive, read everything I could, read Nelson Nash's Becoming Your Own
Oh yeah.
Banker and all that. And so at that point I was hooked. And because I had taken, helped my wife and I go from, $150,000 in debt and get out of that pretty quick and
Mhm.
transition that, I'd always really felt like nursing wasn't my long-term thing. And I wanted to help people with their money
Mhm.
someday, and found this. And I was so excited about it. I did it, with our finances, pretty much immediately was like, I'm in, let's do this. And just, it's such a different way of thinking. And so then once I got into it, I was like, well, how do I show other people this? How do I spread this message
Mhm.
that I think is pretty powerful and transformational, and kind of probably how you feel? It's like a calling to share that
Mhm.
with people and to that can change their lives. And so that's kind of how I found it. Was just, I was listening to a podcast while the kids were playing at a playground and I was walking around and I was like, what the heck is this? So
Wow, it's crazy how things like that happen, right? Just for like a podcast. I think I told you this before we started recording. I got into bank on yourself just from reading a book, just for like fun. I was just reading a
yeah,
book, and then that led me into a business, a career, completely changed the direction I was going. So I feel you.
yeah,
It's crazy how like life works like that. Now, when you
yeah,
were reading the book, Nelson Nash's book, I love that book, by the way. What
yeah,
are some things that you were reading that you're like, what, this is for me, like some specific, because infinite banking, we can get into more, but it has different
sure.
parts. What was one thing that really like was relevant to you?
Yeah. I mean, that's a tough question because there's a lot,
Yeah.
but if I narrow it down, he just talks about the amount of interest that you're paying out over
Hmm.
your lifetime to,
Hmm.
um, you know, for your car, for your house, for everything that the typical American is
Hmm.
doing, and then recapturing that, and that interest. And even that when you're paying cash,
Hmm.
you're losing out on interest, the opportunity cost that you could have repaid yourself. And so that was just something I had never thought of, because I still had a little bit of Dave Ramsey in my head of like, pay cash for everything, right?
Yeah.
And so that idea of loaning yourself that money,
Hmm.
and repaying it to yourself was just, I mean, it took me a little bit. And honestly, when I first read it, I was like, is this a Ponzi scheme? It's like, uh, and then the other thing that really stuck out that took me a little bit to grasp was that constant compounding, that,
Hmm.
you're able to put that money to work, but it continues growing at that tax-free 4 to 5% guaranteed rate,
Hmm.
and that you're using the insurance company's money. And so for me, that was a big mindset shift. It took me a little bit to really get that. And so, And then there's just so many other things he talks about, I mean, I think at one point he calls the IRS the biggest thief in the world. And, so, or at least if he doesn't, he hints at it, and so, so there's just a lot of things that I really connected with there. And I appreciated his message. I'd be curious what I know you're the interviewer, but what you stood out to you as well when you read it.
Yeah, for sure it was the interest. It was him talking about how much he was spending in interest. And then that got him thinking about how he can like change the table. And that's what it's about, right?
Yeah.
It's about like transforming like the dollars you spend. It's not necessarily about spending more money on insurance. Rather, it's about diverting cash. So that way you're literally becoming your own banker. And you mentioned a good point. Like, why do we just use cash for everything? Well, if because you ultimately are financing everything you buy, either through cash or through borrowing from somebody else. And both of those have pros and cons. But I guess the third step would be, the third layer would be to become your own source of own source of financing.
Yeah.
That, and then also it's like this. Are you familiar with the staircase model, where it's like somebody who saves and then spends that savings back to zero, and then somebody who borrows and then pays back their debt is back at zero. So the saver and the debtor end up in the same place. But with infinite banking, you have the ability to grow your wealth, borrow against it without interrupting the wealth. So and I think that's where thinking like a bank comes in.
Like a curve.
Exactly. Yep. And you're borrowing from that curve without interrupting it. And this is where thinking like a bank comes in. It's like, how do I never lose money? How do I retain the money I'm making right now and bring this with me into the future? And you need a vehicle. You need some sort of solid financial vehicle to do so. And that's where infinite banking comes in. Now, Drew, how are you using infinite banking, like personally for yourself?
Yeah. So the first thing I did, you mentioned it in my bio, is I'm very into Bitcoin. And so, so I took a policy loan pretty quick after I got mine open, because I had Bitcoin was still lower back then. And so I was like, I had this, I mean, I could have been wrong, honestly, but I had, I felt confident, I'll say, that we were going to go higher. And so, I mean, I don't mind sharing the details, but it was around, like 19,000. I took out a $19,000 policy loan, and I bought a full Bitcoin around then.
Okay.
And I'd been investing, here, just kind of doing dollar cost averaging with Bitcoin.
Yeah.
And so I took a loan there. And now some Bitcoiners may not agree necessarily with my strategy, but then from what I did there is I stored it on BlockFi, where I get, I get an interest rate, or, it's a high yield savings account, I guess I'd say.
Okay.
So I get about 5% on that. And I use that to pay back the policy loan. It's not, maybe the exact way I would, do real estate. But it's a long-term thing for me. So, and so if you look at the numbers, so you put the 19,000 into Bitcoin, and there's been a lot of talk about Bitcoin lately, but even then it's still, it's around 35,000 this morning.
Okay.
I haven't sold any of it. I've just paid back, the interest, since it's an interest only loan in my policy. I paid back the interest this year. But I'm also getting, that 19,000 is compounding inside of my banking system, inside of my policy. So that's one way I've used it. I'm also looking to use it currently right now in some real estate deals. Been looking at mobile home parks, and I know a few investors as well that do that. My first thing I wanted to do was the Bitcoin, and now it's using it for the real estate. I've also provided some financing for mobile homes as well in the past, but now kind of transitioning to parks.
Okay. Now, when you bought the Bitcoin, you took out a loan, and you said you're paying back interest only on the loan. So that means, for example, a lot of the carriers, right, it's like 5% interest right now.
Yeah.
So you're just paying back just the interest on the $19,000 loan.
Correct. Yep. So that's simple interest. They charge me, 5% of $19,000, and I paid it back here actually just a few months ago. Okay. And right now, because I'm getting that high yield savings account, it's pretty much just paying back the loan slowly for me. Okay. If I was doing real estate, with it, which I will be here, I would be using my tenants' money to pay that back, obviously. Yep. Built that through. But yeah, so it's simple interest only. Anything I pay back to it goes to principal first. So it's not like a, traditional amortization schedule type loan. Yeah.
Yeah, definitely. Now, when you're gonna get into real estate soon, are you planning on doing so as an active investor or passive? Like, are you gonna invest in somebody else's deals? or are you
Yeah.
going to be? Yeah.
Well, go ahead. Sorry.
Oh, sorry. Yeah, as a passive investor.
Yeah, probably more passive right now. I was more active, like I said, when I was flipping mobile homes and things
Okay.
like that. But right now, just the becoming your own banker stuff has taken up enough time, and read a book called Who Not How, and
Yeah.
realized that I didn't have to do everything. I can find more who's who know how to
Mhm.
do those things. So yeah, so looking to I know a couple connected to a couple of guys who are buying mobile home parks, and so that's kind of where I'm going with that. Yeah.
Yeah, absolutely. Now let's kind of go into like working in infinite banking where you're helping other people do this.
Mhm.
You know, how was the experience of telling this people telling this about telling this concept to friends and family?
Yeah. So that's a good question. I'd be curious your answer on that as well.
Yeah, yeah.
I think at first everybody is skeptical,
Yeah.
and I think that one of the main questions, and I'd be curious what one of the main ones you get is that I get is, well, why have I never heard of this before?
Mhm.
And then the other thing, and I know I've said Dave's name a lot on our
Yeah.
podcast, but
It's all right.
he's turned a lot of people off
Yeah.
to whole life insurance. So
Mhm.
when you first throw out there, well, that we're using whole life insurance in this way to become your own banker, a lot of people just immediately are turned off to, well, whole life insurance is a terrible investment. I've heard it's
Yeah.
just, horrible place to put your money. So that's still, a lot of times. And at first when I was sharing it with people, I don't think I was very good at sharing it. So that was the first problem. And now people are very intrigued by it. They're hearing it more and more.
Mhm.
But when I first started sharing it, it was kind of like the same questions I had, like, is this a Ponzi scheme? This sounds like, like, do I have to get my friends to do it? And then I got to get the next guy to do it, type of a thing.
Yeah.
But yeah, the main one I get a lot is like, well, if this is such a great thing, why have I never heard about it? But I'd be curious what you get a lot on those.
Yeah, so actually you brought up a couple points. So I already had a background in insurance. So I was constantly in that mode of like calling friends and family, like, hey, I work at Allstate. Hey, I work at Blue Cross. Hey, so constant
Yeah,
like prospecting within. And this is something that a lot of companies do is they have advisors and agents prospect within their inner circles first, because it's typically easier. But the problem is with me is that I had a bet when I was 19. I went to like this one guy was like, hey, do you want to start your own business? And I was like, yeah. And we went to like this like conference place, and it turned out to be like an Amway MLM marketing thing.
okay,
And,
yeah,
and then they're like, all right, let's call everybody on your phone book right now. Let's pull out your phone and just call everybody on there right now, everybody. And so the idea of when I got into infinite banking, the idea of prospect to friends and family kind of like haunted me from
yeah,
MLM marketing. But on
yeah,
a side note, this is why I did the podcast actually, so I could share the
yeah.
content with the audience,
Mhm.
with friends, family. And actually, I've had now after doing the podcast and after being a guest on other people's shows, I've
Mhm.
had like friends and family reach out to me after listening to me on the shows. So you're right, it's weird. And a lot of people, and you mentioned something interesting, is that a lot of people have like their misconceptions about it. Like, as soon as they hear
Yeah,
whole life insurance, and I agree with them, it sounds kind of scary, right? Like whole life
right.
insurance, like, and it sounds, people think of Dave Ramsey or Susie Orman or other negative things about whole life insurance. Like, number one,
Right.
it's super expensive. Number two, it's illiquid.
Yes.
Number three, it's a terrible investment.
Yeah.
And the thing is, Drew, is that that could be true, right? If it's not from the right company, not structured
Correct.
properly, not from
Yep.
the right, there's
Yeah.
skill involved. It's not just any whole life insurance from any company. This is
Yeah.
why, what we do, we're trained in an area, with we use mutual insurance companies, paid up
Yeah.
additions riders.
Yep.
We use companies non-direct recognition, things like that to help
Yeah.
clients actually use these. Um, let's see. Now, what are
Yeah.
some, yeah, sorry, go ahead.
No, I was going to say that's the thing that, I tell people a lot is, if the average just insurance guy came over and tried to sell you a whole life insurance policy, I would agree. I would say, don't
Yeah.
do it.
Yeah.
But that's the thing, is that this is a specifically designed
Hmm.
policy set up for banking needs. And so, I mean, technically Susie Orman and all those guys are correct, because they're looking at,
Hmm.
they're not comparing apples to apples. It's apples to oranges, right? They're
Yeah.
comparing the bad product, they don't know they've never really genuinely looked at what we are designing and how that works. Cause I think, if they did, they'd see
Hmm.
it's actually pretty great, but then they wouldn't want to promote that. But so, so it has to be specifically designed
Mhm.
for this function.
Okay. Can you share with us a story of how, like, you met a client and then you did like, X amount of dollars and why you did it that way for that client? Like a more of a
Yeah.
technical story?
Yeah. Um, so I've got, two. One is my brother.
Mhm.
But I won't share his story. I don't think
Yeah.
he wants me to share on it. But his is a good one. So maybe I shouldn't have told you. I should have said I have this guy. But no, I have a real estate investor.
Mhm.
And he was already a little bit skeptical of just storing his money in a bank in general.
Yeah.
And heard the message and asked a few questions. And so we ended up designing a policy to put about 120,000 into his policy that, each year for the first 3 years.
Mhm.
Um, and then, he immediately took a policy loan and is flipping a home already. And so he's doing that. And then he's looking at also buying a business with it,
Mhm.
which again, it's really, I harp on this on my LinkedIn this is an and asset. So,
Yes. Mhm.
he can, his money's going to grow inside of his banking system, but he's also going to put it to use to buy a business, to flip real estate, and it's going to grow outside of his system. So he's getting both. And so, one of the things I get sometimes, investors will be like, well, I've got these deals going on. So maybe I'll do that later,
Mhm.
or whole
Mhm.
life later, or the whole life banking thing later. And I always try to bring them back to, what, you can do both.
Yeah.
You can put this money in here, and then as soon as it's in there, yeah,
Mhm.
go take it for your business, go take it for your real estate deal. So back to this guy. So he's already taken a policy loan
Mhm.
for a flip. And I can't remember the exact amount he took. I think it was around 60 or something like that out.
Mhm.
Um, and then he's again, he's gonna put that right back in his system once that flips over. He's looking at buying a business as well. So he's looking, and you probably get this too. Sometimes people initially ask, what's the least I can put in there?
Yeah.
And this guy's asking, how much can I get in there? Because he's thinking about like, oh, I've got taxes on real estate on my business.
Yeah.
I've got, repairs I'm gonna have to make. And so why not put it all into this tax sheltered vehicle? So I hope that's a helpful example.
Yeah, you just mentioned something right now. So definitely. So I think a lot of people come into this like with a commodity mindset where it's like, this is insurance, and how do I get as little as possible of it? How do I get the cheapest amount of it? And
Yeah.
that's typically how it is for all insurance products, usually from term life insurance. It's all about the cost, auto insurance, homeowners insurance, commercial insurance, liability, all these different types of insurance. And then I think when people initially get introduced to infinite banking, they put it into that same category where this is an insurance product, it's a commodity. I need the lowest price possible. It has to be price driven. But
Yeah.
it's not a commodity, it's a concept. It's
Right.
a way of living and a way of financing. And I
Yeah.
think
Absolutely.
when you enter people into that realm and they start learning about it that way, like
Yeah.
this is a way of living, then like you said, the table churns now. Now it's how
Yeah.
much what's the most I could put into this? What's the max? What's the
Right.
mech limit? Do you mind sharing what
Yeah.
that is? Like what is like the mech limit, for example?
Yeah. So each policy has one.
Yeah.
And it's really dependent on a lot of things, person's age and health and all that, and how
Hmm.
much they're putting into it.
Hmm.
But it's basically, the way I describe it in layman's terms is, it's basically a limit that each banking system or policy
Hmm.
has, that if you were to cross it, you've now created a taxable event, and it's a
Hmm.
taxable vehicle. And so every policy has it. We try to design ours, and I'm sure you do the same, so that you have room to
Hmm.
bank with it, to use it, so that, and then our company, and I'm sure yours is the same. We don't let people just cross the mech limit and be
Yeah.
like, oh, tough luck, man. You're gonna get a
Yeah.
bunch of taxes. Good luck.
Yeah.
But no, so we say, like, and like one of the companies we work with is Emeritus, and so
Hmm.
but all the companies pretty much do this. They'll say, hey, Drew, you're about to cross the mech limit with
Yeah.
this payment. You sure you want to do that? Because they don't want you to mech it either. So, but that's the basic way I describe it to people.
Mhm. Yeah, like and MEC, for those of you who don't know, means modified endowment contract, because typically the
Oh yeah, I should have said that.
insurance policy typically is, there's a lot of tax advantages under the IRS tax code. Now let's say, for example, somebody wants to put $10,000 a year into a policy, I think maybe just doing a rough estimate, the MEC limit might be like $11,200, maybe just something like
Yeah.
that. And not
Yeah.
it's not proportional to that, but it's just let's just say $11,200. This means every year they can add up to 11,200, and I think it changes every 7 years, right? There's like an average; it changes every 7 years.
Yeah. 7 pay test. Yep. Yep.
Yep. So yeah, as long as you don't reach out, and even if you did, like I've had clients before, like add more cash on top of the MEC limit, and then the insurance company, what they'll do is they'll deposit it up to the MEC limit, and then they'll write a letter and call the client and say, we can't deposit more, and if we did deposit more, it's going to be a modified endowment contract. Are you comfortable with doing that? So they
Yeah.
do add additional obstacles to make sure
Yeah.
that's not just like a technical problem where it's, oh, you just deposit this check, now it's going to flip into a MEC policy. They do have those
Right.
obstacles in place to protect clients from reaching taxable events.
Yeah. So is that when you guys say, hey, time for a second policy?
Yeah, of course. Yeah. Yeah, definitely.
Yep. Yeah.
That's a, you just brought up a good point. That's again back to the whole concept of risk commodity. It's very common. Most of our clients are working on their second and third policy. That's a very normal thing
Yep.
to do. My
Yep.
mentor has 14 policies. He's been doing this for 10 years, both as a client and as a professional. He has 14 policies, so it's very common for people to have numerous policies. Again, this isn't auto insurance where you just need one type of it. It's not homeowners insurance where you just need one policy. This is a way of living. It's a way of financing.
Right. And that's so one of the guys in our group, Jim Oliver, he's the creator of Create Tailwind, which is the group I work with. And
yeah,
I can't remember the number. Someone told me, and maybe it was him, that he's almost close to 30 or something. And I'll have to get back to you on the real number. But and it might be a good thing to address here, but is the different, and they're not all on him, right? So he has business partners, he's got family members that he has an insurable interest in. And so, if you don't mind me talking about this, but really, the way insurance company views it is, you have to have an insurable interest on that person at the time that you insure them.
Yeah.
So 5 years from now, you may not, but when you insured them, you did. So if you have, a business partner, a key employee, things like that. And so that's why, Jim is able to have like 30, I have 2. I'm working on 3 and 4 for my kids. But so it's, you can insure different people, not just, yourself, as sometimes people don't maybe know or understand that.
Yeah, that's a good point. Yeah. You could insure kids, you can insure business partners, employees, like you said. Exactly. Yeah. And another thing too is, like, for example, for employees, I think the rule is they just have to work for you for like 2 weeks, and then that's it. They could leave, quit, get fired, whatever, but you could still keep the policy on them forever until they pass away ultimately.
Yeah, I heard. So I heard a story about Walmart. They used to do this.
I was just about to say Walmart.
Every employee, they've got like thousands of employees out there that they have insurable interest in, and I think the government came in and said something. I'll have to look it up, but it was like around like management level now has to be. They were like getting the door greeter, the person stocking stuff. They were taking policies on all of them, but which is another great topic to address, is that there's companies out there, there's banks out there, using this. And that's why, and people say, I've never heard of it, but it's like, you just got to look dig a little deeper, because there are companies doing this.
Absolutely. The term COLI, corporate owned life insurance, and BOLI, bank owned life insurance.
Yep.
Banks and large corporations own the majority of life insurance. Most life insurance, most cash and life insurance are owned by bank and large corporations. I think all banks collectively own $190 billion in life insurance alone. That's just banks only, excluding corporations. And think about it.
It out. Yeah.
And think about it, like, where else would because here's the counterintuitive part right here, is that think like Jeff Bezos, think like the people who run Apple and Google. Where do you think they're going to put their money? They're not going to put it into a bank account. Why? Because of inflation, because of creditor risks, because of the loss of opportunity cost they could have earned had that money been invested other places. They're not going to put it into the stock market. I mean, they might have some in the stock market, a little bit, just to kind of play in the stock market, but again, volatility, market risk, it's not a smart thing to do. So their money has to live somewhere. It has to, I wouldn't be surprised if Jeff Bezos has, $1 billion with each life insurance company out there, at least, because think about it, his money has to live somewhere. It's not going to be in a bank account. It's not going to sit in the stock market. It has to live somewhere that's going to grow tax deferred. It has to be liquid, accessible. And it also there has to be a legacy behind it. It has to,
Right.
the life insurance, the tax advantages with that to the next generation. So definitely, I think like it's important, like I talk to a lot of real estate investors too, when we start talking about the numbers and it starts getting close, like, oh, well, I have to tie up X amount of cash for the premiums. And I'm like,
Yeah.
where else is your money going to live? Eventually, let's just
Right.
say you go from
Yeah.
10 properties to 1,000 properties. That's more
Mhm.
money. Where is that money going to live? You don't want all that money living in the dry walls of your homes. You don't want that money just sitting in equity.
Yeah.
You
Yeah.
want liquid cash that you could use for other
Mhm.
deals. Now, let's talk
Right.
about like the actual loan process. Is that a hard process to get a loan from the insurance company?
Yeah, no, not at all. So, uh, if you've ever gotten a loan from a bank, I mean, you got to get like dog vaccination records, right? You got to get like all those details,
Yeah.
where you went to elementary school, who your third grade teacher was. But the insurance company, because, the two of us are going to
Yeah.
design it in a mutual insurance company.
Hmm.
You are, considered a shareholder. And so as part of that, you have access to policy loans. You have rights that have policy loan. And so when you call the insurance company and say, I want to take a loan, you don't get 25 questions about, well, what are
Yeah.
you doing with that money? Where are you going to,
Hmm.
where, and but it's actually more like, okay, well, where do you want it and how soon do you need it?
Hmm.
And so for me, like when I did my Bitcoin, when I asked for it in the morning on like a Monday,
Hmm.
and I think I had it by Tuesday morning the next day.
Oh, wow.
And I've had others where people get it in the morning and they get it in the evening,
Hmm.
but we always say 1 to 3 business days, but it's very liquid. It's, I mean, there's no questions asked. They don't ask you what you're doing with that money, right? That's
Hmm. Hmm.
it's for all intents and purposes, it's your money as well. So even though you're using their money, but they allow you to take a loan. Is that fair, you'd say?
Yeah, absolutely. It's one page. What's your policy number? What's the most you want? You could get up to maximum up to 90, usually 90-95% of your cash value. And then
Yeah.
yeah, do you want it as a check or do you want it, ACH deposited into your account? Um, and this is the advantage for especially a lot of real estate investors, because I hear a lot of people, not just real estate investors, but like friends and family, they're like, oh, I can't wait until there's the next market crash for real estate because I'm just gonna buy a bunch of real estate. Well, here's the
Yeah.
thing. Think about it this way. If there's a market crash and real estate values drop, do you think banks are going to be just giving out money freely? No, they're going to
Right.
tighten up
Yeah.
their restrictions, because
Yeah.
usually in a market, in an economic crash situation, that typically
Mhm.
means that unemployment goes up and there's some sort of hardship, economic hardship in
Yeah.
the economy, and banks are constantly monitoring that. So when there's some hardship, they start to tighten up, they lift up their credit score requirements, and banks can do this at any time. They're in control of their money. They can, they
Right.
lift up their requirements. So that means that it's like a negative correlation, meaning that when market values go down, bank requirements are going to go up, and that's not going to help you anymore
Right.
unless you have a source of financing that is not connected or tied to economic situations, meaning that Lafayette Insurance Company, one of the companies we use,
Right.
they're going to
Yep.
give out policy loans regardless of how the economy is doing, regardless of the unemployment rate, regardless of the stock market, regardless of all these
Yeah.
things. Whereas banks do the opposite. They give out loans based off of those metrics, not just based off of
Right.
somebody's credit score individually, but also off economic situations. So this
Yeah.
is
And
where a true like real estate competitor can come in and say, I'm going to buy all this real estate regardless of the values of it or regardless of
right.
banking requirements, because they have
Yeah.
their own source of financing.
Yeah. And I think something people don't, a lot of times that they don't realize is just how financially stable or solvent that insurance companies are. I mean, I read something the other day that said if everybody, died and they paid out all the death benefits, I think they'd still have 13% left over of their money.
Yeah.
Whereas the bank, they have less than 1%, of all
Yeah.
deposits on hand.
Mm-hmm.
And I put a poll out the other day, actually, it's kind of funny, saying, how much of the insured deposits does the FDIC actually have on hand?
Mm-hmm.
And I said, like, what I gave 4 options. What are the percentages? The answer is less than 1%. And there was actually somebody, because, on LinkedIn, you can see the results. There was someone from the FDIC, and I won't call out their name, who responded 100%. And I just laughed. I was like, you need to do your research, man. I mean,
Wow.
you're working there.
That's
And so,
funny.
in time, yeah. So I think that's another thing that, people don't realize is that, your money is actually safer in these companies have been around for hundreds of years, right?
Mm-hmm. Mm-hmm.
And so your money is guaranteed. Like sometimes you don't like the word guaranteed, but it's like your money actually is guaranteed to be there versus in the bank, it's not, right?
Yeah.
I mean, banks have been bailed out how many times? So just to add to your point there.
Yeah, and thanks. You just brought up 2 points now I want to talk about. So yeah, definitely. There's a book called All About Annuities, and the author mentions. Have you read it? Have you read the book All
No?
About Annuities?
Yeah.
That book actually gave me a lot of like. It's obviously about annuities, not so much about life insurance, but annuities are issued by life insurance companies. They're technically like almost like life insurance products. And
Mhm.
the owner, the author of the book was saying that if you took all the cash from U.S. life insurance companies only, just life insurance companies in the United States, you took all that cash and
Yeah.
piled it together, it would be greater than all of the cash from all the banks in the world and oil companies in the world combined. So that
Yeah.
gives you an idea of how much cash these life insurance companies are sitting on, and they have to.
Right.
They have to because of their requirements. They have to meet all the death benefits. They have to promise all the cash value, the policy loans, all the withdrawals, everything else. They have to promise those in writing.
Right.
And then another thing too, you mentioned guaranteed. Like I've talked to financial professionals before, and I would start talking about guaranteed, and they'd say, whoa, you can't use the word guaranteed. And I'm like, yeah, I
Yeah.
can. And like no, you can't use the word guaranteed with an investment. And I'm like, this is not an investment, it's a savings
Right.
vehicle. So
Yep.
it's a guarantee, it's guaranteed. It's literally, it's been guaranteed too. It's not just like a
Yeah.
recent thing. It's been, people who survived through the Great Depression, who made it through the Great Depression, either individuals and companies and families, were the people who had whole life insurance through the Great
Yep.
Depression because their
Yep.
whole life policies weren't hindered or affected by
Mhm.
everything else that
Yeah.
happened in the world during that time.
Yeah. You probably know this story already, but Walt Disney,
Yeah, yeah,
he couldn't get a bank loan, right?
yeah.
He took a loan from his insurance company. And then there's I think it was the Pampered Chef lady back in the day. That might be before your time, man, but but she did the same thing, so yeah, it's been around for a long time, and no bank was going to take a chance on Walt Disney. And I mean, my kids would be deprived of Frozen if that had never happened. So and I would be too.
So Drew, we talked a lot about a lot of different things. We talked about the tax advantages. We talked about liquidity, being able to borrow, market protection against market risks. What else is there? Like, what else is there that you want to touch on, or some other advantages, some things you want to touch on for the audience to really kind of take a deeper dive into infinite banking?
Yeah, I think there's a couple of things like you mentioned it just a second ago. Some people look at this and they're comparing it to investing,
Mm-hmm.
right? You talked about it. It's a savings vehicle, safe, liquid savings vehicle.
Mm-hmm.
The other thing that I think infinite banking really, and going back to Nelson Nash's book, hits on is this idea of, and Nelson says it, that motion is a law of God or a law of nature, right?
Mm-hmm.
And so money isn't meant to be stagnant. If air has to move in and out of your lungs, your blood has to circulate, or you die, right?
Mm-hmm.
And so this idea of, we're not talking about your money just sitting here and doing nothing in this. We're talking about, putting it into the system and then using it to grow your wealth further, right? But you're going to get the growth in there, but you're going to get the growth outside of there. And so for me, that's one of those things of like, sometimes I'll show someone, the policy and the numbers, and they get really caught up on those numbers. And it's like, well, that's not just, infinite banking isn't just these numbers on a page. It's a
Yeah.
different way of thinking, it's trying to control the money supply in
Mm-hmm.
your life and take back that control that the banking system has and put that in your hands, and like I said, like you said in my bio, putting the banking on the me and you level, right?
Yeah. Yeah.
So those are just a couple of things I just like to always point out to people, is that this idea of, putting your money into motion and generational wealth, and that we're not talking about just storing it here and it doing nothing,
Yeah.
and we're also looking at taking care of the next generation. And so I'm rambling, but I want to say the other thing that sometimes I think is pretty cool is you have people that they've been advised to, put money into a vehicle for their kids to go to college, right?
Mm-hmm.
And that
Mm-hmm.
there's all these limits and rules on that
Yeah.
money.
Yeah.
But if you do a policy for them, say you have a kid that wants to get into real estate, or you have a kid that wants to start a business, or go to a different schools, in Europe or something.
Yeah.
That's one of the other powers of this system, is that, you can put it here and you can teach your kids about money and about
Yeah.
policy loans, and they can use that. when they become of age. But in the meantime, you can even train them. And so that's something, like my daughter and I, we were just talking
Mhm.
about. I was like, I taught her how to save and taught her some of those things. And now I was like, actually, literally this morning, I was like, so next we're going to learn about putting your money in motion, So I went on a long rant, but those are a few of the things I really think are important for people to think about.
Yeah, I love it. Yeah, yeah. No, thank you. Yeah, that it definitely means a lot. It's, this is, it's called also, family banking, right? This is also what it's known as. Definitely, I agree with you. Like for example, like 529 college savings plans. They have a
Mhm.
lot of restrictions on them.
Mhm.
I've actually helped a lot. I've helped a lot of clients build out plans for their, 1 year or 2 year old children.
Yeah.
And they pay in it, for example, until they're 18 or 20 years old, and
Yeah.
then by the time they're 20, it's like, because of compound interest, they'll have enough money in their policy to pay for college. And here's the thing, though,
Right.
it doesn't have to be college. Let's say they don't want to go to college. Who knows what's going to happen, 18 years from now in the college
Exactly.
industry.
Yeah. College would be like $300,000 a year at that point. I mean, geez.
Right. You have infinite banking is not about the numbers. It's not about, all right, year one I put 10,000 in, what's my cash value. It's not about that. It's about
Yeah.
options. It's about freedom. It's about financial freedom. It gives you more leverage in your life later on. It's
Yeah.
I think when a client I've had clients say, all right, year one, if I give you X amount, what's my cash value year one? And
Yeah.
then right away, I'm like, this is not the right option. This is not the right solution for you.
Yeah.
If you're
Yeah.
looking at
Right.
year one only,
Yeah.
this is not a good fit. This is
Right.
the next generations for you. This is what it's
Yes.
meant for.
Yeah. And that's a great point. Is, a lot of times current thinking is, what can you do for me now? I need now, and it's just
Yeah.
short-term
Yeah.
thinking.
Yeah.
And this requires a shift to long-term thinking, which is what you're saying.
Yeah.
So you can look at year one, and there is, one of the downsides, which maybe, we didn't totally get to, but is there's cash drag in year one. And we
Yeah.
don't hide that. I know you don't hide that.
Yeah. Yeah.
But if you can look at year, 5, year
Mm-hmm.
6, and especially year 10, you're putting $1 and you're
Yeah.
getting more than $1,
Yeah.
and you're
Mm-hmm.
able to loan yourself more than $1. And so some people, they see that first year and they just get so lost on it. But it's like, but look at year 10, look at year 20,
Yep.
and look at what you're doing for your family. And so that's it really does require, and there are some people who they can't make that shift. They can't think long term like that. They're just thinking about right now.
Yeah.
And that's a little bit of a paycheck to paycheck mindset. And so this requires a shift of thinking to more long term.
100%. Yeah, definitely. What are some books you're reading right now? Like either relevant to infinite banking or not? Just some books you're reading right now you want to share with us.
Yeah, I have two. I won't go into what I'm reading in fiction, but a great one. It's, I mean, literally like, I finished it, is Giftology.
Mhm.
I mean, I finished that like in 2 nights or less. And then I'm eating one for my health, or reading one for my health called Eat Smarter. That's why I said
Okay.
eating, but by Sean Stevenson.
Okay.
So those are the two. And then I'm always kind of got some kind of infinite banking reading going on in the
Yeah.
background. In fact, this is the other one, is How Privatized Banking Really Works, is the other one I'm kind of going through right now as well. So
Yeah, I need to sharpen up. I read a lot of books on like business and stuff. I read a lot of I read, obviously Becoming Your Own Banker, Bank on Yourself, The Richest Man in Babylon.
yeah,
But definitely I need to read more books about, infinite banking and stuff. I want to
yeah,
sharpen that up for sure. How can I appreciate you being on the show, man? It's been a pleasure. Again,
yeah.
it's like
Thank
speaking to somebody who speaks the same language as you, so
you.
it's pretty cool.
Yeah, yeah. And I like the
Yeah.
infinite banking space. Everybody is very, just generous with each other. That it doesn't feel
Oh
competitive, which I
no, no, it's like a community. Technically we're competition, but
right.
but there really is. We don't really, my mentor always says you don't have any competition.
Right.
Mutual fund
Yeah.
people can't do this. Financial advisors can't do this.
Yeah.
A
Yeah.
lot,
Yeah.
we don't really
Yeah.
have competition.
Right. And we just want the word to spread for
Yeah,
people. Yeah. So it's cool.
yeah, yeah, absolutely. How can listeners connect with you and follow you?
Yeah. So I'm on LinkedIn is where I'm most active. So it's,
Mhm.
linkedin.com,
Yeah.
I think /IBC Drew, or if
Uh-huh.
you Google IBC Drew or Drew White, LinkedIn. And then I have a website also that's just ibcdrew.com.
Okay.
I'm going to be releasing a short video course here soon that
Mhm.
I'm hopefully finishing up this weekend. So those are the two places. And then you can email me if you want at drewhite@createtailwind.com.
Okay, perfect. I'll be sure to add in all the links. That way people can just click and follow you. Drew, thank you so much for joining us. I look forward to having you back on our show. Also, when you get you don't have a show yet, right?
Not yet, no.
Yeah, okay. When you
But
do,
you'll be
I'll
one
be
of my
out.
first guests. Yeah, yeah.
For sure, for sure. Sounds good, man. Thank you.
Hey, thank you, Sari.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.